Hi, this is Money and Investing. Welcome to my new video in the Financial Ratios series. The price earnings to growth ratio, or PEG ratio, is a stock's price to earnings ratio divided by the growth rate of its earnings for a specified time period. The PEG ratio is used to determine a stock's value while also factoring in the company's expected earnings growth. This is thought to provide a more complete picture than the more standard PE ratio. By the way, if you like this kind of content, hit the like button and subscribe. It will really help out my new channel and give me inspiration to create more content like this. Thank you. The PEG ratio enhances the PE ratio by adding in expected earnings growth into the calculation. The PEG ratio is considered to be an indicator of a stock's true value, and similar to the PE ratio, lower PEG may indicate that a stock is undervalued. As with any ratio, as the denominator, which is the growth rate, increases, the value of the ratio decreases. The PEG for a given company may differ significantly from one reported source to another, depending on which growth estimate is used in the calculation, such as 1 year or a 3-year projected growth. PEG equals price earnings divided by EPS. Price earnings, which I did in a previous video, is just price divided by EPS. Once the PE is calculated, find the expected growth rate for the stock in question, using the analyst estimates available on financial websites that follow the stock. Using historical growth rates, for example, may provide an inaccurate PEG ratio if future growth rates are expected to deviate from a company's historical growth. The ratio can be calculated using 1 year, 3-year, or a 5-year expected growth rate, for example. To distinguish between calculation methods using future growth and historical growth, the terms forward PEG and trailing PEG are sometimes used. What does the price earnings to growth ratio tell you? While a low PE ratio may look like a stock is a good buy, factoring in the company's growth rate to get the stock's PEG ratio may tell a different story completely. The lower the PEG ratio, the more the stock may be undervalued given its future earnings expectations. Adding a company's expected growth rate into the ratio helps adjust the result for companies that may have a high growth rate and a high PE ratio. The degree to which a PEG ratio result indicates an over or underpriced stock varies by industry and by company type. As a broad rule of thumb, some investors feel that the PEG ratio below is desirable. According to well-known investor Peter Lynch, a company's PE and expected growth should be equal, which denotes a fairly valued company and supports a PEG ratio of 1. When a company's PEG exceeds 1, it is considered overvalued, while a stock with a PEG of less than 1 is considered undervalued. Now we'll go into an example of how to use the PEG ratio. So we have two companies, Company A and Company B. For each company, we have the price per share. We also have the EPS for last year and then this year. So we can calculate the EPS growth rate. For Company A, the PE ratio is the price per share divided by the EPS. So that would just be 46 divided by 2.09, which is 22. Earnings growth rate equals 20%. So basically the PEG ratio would be the PE ratio divided by the earnings growth rate, which equals 1.1. Now Company B, PE ratio equals 30, with their earnings growth rate of 50%. So that makes the PEG ratio equal to 0.6. Many investors may look at Company A and find it more attractive since it has a lower PE ratio between the two companies. But compared to Company B, it doesn't have a high enough growth rate to justify its PE. Company B is trading at a discount to its growth rate, and investors purchasing it are paying less per unit of earnings growth. This is Money and Investing. Thank you so much, guys, for watching my video. Let me know your comments and what you think below. To those who are still watching, you're amazing. If you like this content and would like more investing videos, please consider supporting me at my Patreon link below, or get a free stock when you open an account with Robinhood. If you want more content like this, please consider hitting the like button and subscribing. It will really help out my new channel and give me inspiration to create more content like this. Thank you.